Building a business emergency fund starts with knowing exactly what your business must pay every month to stay operational. Many owners make the mistake of saving an arbitrary amount instead of calculating a realistic target. Begin by listing your non-negotiable monthly expenses, including payroll, rent, utilities, insurance, software subscriptions, internet, loan payments, accounting services, and any supplier commitments that cannot be delayed. Ignore optional spending and focus only on expenses required to keep the business alive during a difficult period. Once you have that total, multiply it by at least 3 months. Although 6 months of essential expenses provide stronger protection for businesses with seasonal or unpredictable revenue. Open a separate business savings account that is used exclusively for emergencies and never mix those funds with your daily operating account. Keeping the money separate reduces the temptation to spend it on routine purchases. Automate transfers into that account every week or every month, so saving happens without relying on willpower. Even a small automatic transfer creates consistency, and consistency is what builds a meaningful reserve over time. Another effective habit is saving a fixed percentage from every customer payment before paying discretionary expenses. This approach allows the emergency fund to grow naturally as revenue grows. During months with unusually strong sales, resist the urge to upgrade equipment or increase spending immediately. Instead, direct a larger portion of those profits into the reserve. Unexpected income, such as tax refunds, supplier rebates, cashback rewards, insurance refunds, or one-time bonuses, should also be transferred into the emergency fund instead of becoming part of normal spending. The objective is to make saving automatic rather than occasional. When emergency savings become part of your financial system instead of an afterthought, the reserve grows steadily without placing unnecessary pressure on daily operations, and your business becomes far better prepared for delayed payments, temporary sales declines, or unexpected expenses. After creating the saving system, the next priority is finding additional cash without increasing sales. Start by reviewing every recurring business expense and eliminate subscriptions, software licenses, memberships, or services that no longer provide measurable value. Many businesses continue paying for tools they rarely use simply because nobody reviews the monthly statements. Redirect every dollar saved from these reductions directly into the emergency account instead of allowing those savings to disappear into other expenses. Review inventory purchasing habits as well. Ordering excessive inventory ties up cash that could strengthen your financial position, especially if products move slowly. Improve inventory planning so money remains available instead of sitting on warehouse shelves. Accelerating customer payments is equally important. Send invoices immediately after completing work, provide clear payment terms, follow up consistently on overdue invoices, and consider offering small early payment discounts if they improve cash flow. The faster money enters the business, the easier it becomes to build reserves. Establish a minimum operating cash balance for your checking account. Whenever the balance exceeds that amount at the end of the month, transfer the excess into your emergency fund instead of leaving it available for unnecessary purchases. Delay non-essential equipment upgrades until existing equipment genuinely limits productivity. Financing unnecessary assets increases monthly obligations and reduces your ability to save. Keep personal and business finances completely separate because using business cash for personal spending often destroys financial discipline. Review supplier contracts regularly and negotiate better pricing or longer payment terms whenever possible. Small improvements across multiple expenses often create thousands of dollars in additional annual cash flow, and directing those savings into an emergency reserve strengthens the business without requiring a single new customer or additional marketing campaign. An emergency fund is valuable only when it is protected and managed correctly after it has been built. Establish clear rules defining what qualifies as a genuine business emergency before you ever need to use the money. Equipment failures that stop production, unexpected legal expenses, temporary revenue declines, critical repairs, cyber incidents, or sudden cash flow shortages are legitimate reasons to access the reserve. Planned marketing campaigns, office renovations, new furniture, hiring ahead of demand, or expansion opportunities should never be funded from emergency savings because those expenses can be anticipated and budgeted separately. Review your emergency fund target every quarter because businesses change over time. Another smart practice is to connect your emergency fund to your annual budgeting process instead of treating it as a separate financial goal. At the beginning of every year, estimate the major risks your business could realistically face, such as higher supplier prices, slower seasonal sales, rising payroll costs, unexpected tax obligations, or important equipment reaching the end of its useful life. As your company expands into new markets, hires more employees, or adds new product lines, revisit these risk estimates so your emergency fund continues matching the true size and complexity of your business. As payroll increases, rent rises, or new operating costs are added, your reserve should increase accordingly. Test your preparedness by asking whether the business could continue operating for several months if revenue suddenly dropped or a major customer stopped paying. If the answer is no, continue strengthening the reserve before taking on additional financial commitments. Whenever emergency funds are used, make rebuilding the balance your highest financial priority instead of delaying replenishment until the following year. Continue monitoring cash flow, profit margins, accounts receivable, inventory levels, and monthly expenses because strong financial management supports long-term savings. Encourage department managers to control unnecessary spending so the business preserves cash without reducing quality or customer satisfaction. Every financial decision should contribute to stability rather than creating unnecessary risk. A well-funded emergency reserve gives business owners time to think clearly, negotiate better solutions, maintain employee confidence, continue serving customers, and avoid relying on expensive debt during difficult periods. The greatest benefit is not simply having cash available. It is having the freedom to make rational business decisions under pressure because your company has already prepared for uncertainty before it arrives. If you found this video helpful, then like, share, and subscribe this channel to get future videos. Thank you for watching this video.